Hello, I'm Lelda Smits for the Finance News Network, and joining me from the Antares Small Companies Fund is Portfolio Manager Stuart Wilson. Stuart, welcome to FNN.
Thanks, good to be here.
When do small cap stocks tend to do well, and what are you looking for in a stock before you enter the position?
Smaller companies are typically more sensitive to the economic cycle, and this is really a function of the types of industries that they're in, and also the fact that smaller businesses typically have what you'd call less pricing power than larger companies. And so therefore, when economic conditions are weak, they tend to have lower earnings, but as economic conditions are weak and recover, you typically get strong earnings growth, and you also get typically a re-rating of the stock. So that's when you get really the best performance out of the small end of the market.
Now, your benchmark is the S&P ASX Small Ordinaries Accumulation Index. How has the fund performed relative to the index over the September quarter and further back?
So the fund pretty much performed in line with the index over the quarter. Now, it's really important to remember that the small company fund and share funds in general are actually very volatile from quarter to quarter, and they're really suitable for longer term investors. So if we look at longer time frames, if we go to, let's say, 5 years, the fund performs 6% per annum after fees, which is around 6% per annum after fees better than the benchmark over 5 years. Over longer time frames, so since the start of the product back in 1996, the fund has returned 12% per annum after fees, and the fees are quite low, which is around 6% per annum better than the benchmark. So what this means is that additional outperformance compounded over long time frames can actually have a very significant effect on the total returns for investors.
And Stuart, which stocks have supported your performance and which have detracted?
Slater and Gordon and Ardent Leisure, which I guess have really been some of the longer term stalwarts within the portfolio, have continued to perform well. So they came out with very positive earnings results during the recent reporting season. And the outlooks that both companies gave were very promising for the years ahead. I guess some of the recent acquisitions to the portfolio have also done well. So stocks like Covermore, Mantra and Ice India Group have also done very well. Set against this, a few of our resources exposures have been a bit weaker. So particularly BC Iron and Tiger Resources fell during the big resources sell-off that we saw during the quarter. And also Tox-Free, which actually came out with a very disappointing earnings result for the second half financial 14. And looks like we'll have relatively weak earnings going into 15, but this will then recover in 16 and 17, you see. So from these levels, we actually think that's a good investment too.
Now, when we last spoke at the end of the March quarter, the fund had benefited from investing in housing and retail stocks. How has your exposure to both changed over the year?
And we did have a fairly significant exposure to housing construction related stocks, primarily in CSR and Fletcher Building Group. What has happened is those stocks actually performed well up to around middle of the year. And at that point in time, we really thought they'd reached full valuation. So we started trimming those stocks a fair degree. In the subsequent sell-off in the market during the September quarter, both stocks have come back. And actually we think they're good value at current levels, and we're happy to continue to hold them, given that the housing recovery is still coming through. Now, as relation to the retail stocks, yes, we had a very big exposure in retail stocks, and they did fantastically well up till around the middle of the year. What we noticed then coming into the election was that we felt consumer confidence was likely to weaken, and also this would have an impact on consumer spending. So that's obviously a negative for retail stocks. And additionally, there was quite warm weather down here in Melbourne, and we saw that there was also in Sydney. So we thought, well, that's particularly bad news for some of the apparel retailers. So Kathmandu, for example, which we'd had for a period of time, we aggressively sold down a fair degree of our holding that we'd made a lot of money on, as well as some of the other retailers. More recently, these stocks have fallen to very low levels. We now find them quite attractive, and we've significantly rebuilt these retail positions at materially lower prices.
Finally, Stuart, which sector of the small cap market is showing promise at the moment?
Well, we still like a number of the housing related exposures through the cycle coming through. We quite like some of the retail names, even though retail spending isn't that strong, just primarily because of the valuations. And the other thing we're finding is across the market in a range of different sectors, there's sort of selective opportunities.
Stuart Wilson, thank you for the update from Antares Small Companies Fund.
Okay, thank you.